Welcome to Seeking Alpha's CEO Interviews. Quality of leadership is a decisive factor in stock performance, so we provide in-depth interviews with the best and brightest CEOs in the public markets. We publish limited excerpts from our interviews on social media platforms and the full interviews at seekingalpha.com and in the highly rated Seeking Alpha mobile app. To find the full interviews, open seekingalpha.com or the Seeking Alpha mobile app and search for the phrase CEO Interviews, or simply type a stock ticker into the search box.
Welcome to CEO Interviews. I'm your host, Jesse Redmond. Today I'm joined by Stephen Farrell, CEO of Convey Health Solutions. Stephen, thank you for joining us.
It's good to be here. Thank you.
Congratulations on the IPO today. We'll jump into the specifics in a moment, but let's start big picture. For investors not familiar with Convey Health, how would you describe the business to someone that doesn't know the company?
Convey Health develops technology for MA and PDP plans. We're focused exclusively on the government sector, and the technology helps with the overall administration of the health plan. We serve 8 of the top 10 health plans by membership nationally. We also have some smaller health plans. We're the gateway for members to access their benefits, and we are the portal that health plans use to administer benefits to their Medicare population.
And you use the terms MA and PDP. Can you just quickly explain what those terms mean for people not as familiar?
Medicare Advantage is a program designed to deliver medical benefits to seniors on Medicare. And PDP is the drug program that Medicare established back in 2006, which was the largest expansion of the Medicare program since its inception, to provide drugs to seniors on Medicare.
And in comparing choices in this space, who do you see as your biggest competitors, and why do people prefer your solution?
So we've developed purpose-built technology. So our technology was designed for the government sector. The competing models are generally an in-sourced team of developers who have bolted 5 to 8 different technologies together to do what our single purpose-built technology does. So in terms of competitors, you can't really look in the market and say there's a single competitor. Usually it's a combination of in-sourced developers at a health plan combined with 5 to 8 different commercial technologies that have been put together to do what our single purpose-built technology does. Since we have purpose-built technology, we can be a less expensive solution and a higher quality in terms of our ability to engage with Medicare members.
And how would you explain the business model to investors? How does the company make money?
Yeah, so we have 3 core technology solutions, and the answer varies depending on each of the technology solutions. So some of them are based on a utilization model. The more of a benefit that a member uses, the more we get paid. One of our core businesses is a per member per month fee. So we get paid by the health plan a monthly dollar amount based on the number of members that we're managing. And then we also have a business that we make money when our clients make money. So it's a model that's more based on us earning money when our clients earn money.
And are the demographics in your favor in this business? Does the aging population, the expansion of Medicare, does all of that play into your favor here?
Yes, absolutely. So the Medicare Advantage membership has grown in the last 5 years by about 7% annually. That's expected to grow by 7% for the next 4 or 5 years. And the trends in our business are even stronger than just the membership growth would suggest, because you have a shift to value-based care. You have increasing utilization of supplemental benefits. And there's also a trend towards outsourcing. And so more and more large plans are seeing that using a firm like ours to develop technology and engage with the members is a winning model.
In 2020, revenue was 288 million, a 28% year-over-year increase. A great job indeed. Can investors expect this kind of revenue growth to continue?
So we have historically achieved kind of mid 20% adjusted EBITDA growth. We haven't given guidance yet for the next 12 months, but we are forecasting over the long term, 3, 4, 5 years, a 15% top line revenue growth objective and 20% on the bottom line. So we're expecting solid growth to continue.
And part of my background is being in the hedge fund industry. And in the hedge fund industry, I was always worried about concentration risk. And that came in two forms. In that business, you had concentration in positions and you had concentration in investors. And sometimes one investor was 25, 30, 40% of our business. And that always made it a little bit hard to sleep at night sometimes, not knowing if that redemption form might come in and the business might really change. I noticed in the risk section of your S1 filing, you discuss having a highly concentrated client base. I think your top 2 clients account for 44% of total revenues. Can you help investors understand what happens if you lose one or both of these accounts and how you're managing that concentration risk?
Sure. So you can't really be in the Medicare Advantage space in any kind of scale without having a fairly concentrated position, just because the large players are big and they're getting bigger. The risk for us, though, in the math you just outlined, really overstates the issue. And the reason it does is in those 2 clients, that concentration is spread out over, I believe, 9 different individual statements of work. And so it's a situation where we could conceivably, although we've never lost a very large statement of work in the 8 years that we've been focused on this sector, but it's conceivable that we could. But I think it's very, very unlikely that we would lose the entire client. We might lose one of those 9 statements of work, but it isn't really a situation where we would lose in a single swipe of the pen the entire account. And the reason is we've got different buyers for each of those statements of work within the large health plans. So your math is right on point, but I think it overstates the risk because we have multiple touch points and multiple statements of work within those health plans. The other thing I'd add is we also have a very long track record with those 2 large accounts. One has been 10 years and one has been 16 years. So we've got a history with our large plans of expanding, not contracting.
And how has COVID affected your business? Has that been any sort of a detriment, and is there any sort of an opportunity there as well?
So in terms of our overall financial results, it held back the advisory growth. So we've got 130 full-time experts in Medicare Advantage and PDP calling on Medicare Advantage plans. Our advisory business is really the tip of the spear in our go-to-market strategy in terms of introducing our technology to the market. But there's been during COVID, especially in the early phase, a reluctance for health plans to allow our team on site. And so it's fairly critical to the advisory business that we have an on-site presence. So COVID did impact the growth there. But we are back on track now and had very good quarterly results, and we're seeing that move in a very good direction. The rest of the business was very well insulated because of the fact that we've got such a strong recurring or reoccurring business model. We have great insight into the future revenue of our account. And we also have a very good history of being able to predict the future. So our recurring revenue model combined with our long-term contracts insulated us from COVID. Of course, we had the mad scramble that many companies went through in terms of moving to a remote workforce, but we did that successfully in the March-April timeframe last year, and then continued to hit service levels throughout the pandemic.
And the company went public today on the New York Stock Exchange under the symbol CNVY. You sold 13.3 million shares at a reference price of $14, which raises about $186 million. Can you share the catalyst for going public and why now is the right time?
Sure. So we have three great core technologies. We have a great advisory business, but we want to do more of what our clients need. And it's frustrating when we are in front of a client and they say, we need help on X, and we don't have a technology that does that. So one reason is we'd like to acquire additional technologies. We will be prudent about it because we can afford to be. We've got growing and strong businesses, so we don't have to do M&A work, but we're likely to do some deals here, and the public markets provide liquidity to do that. The second thing is the public marketplace will provide a higher stature for us. And it's critical, even though we have great technology, we need to continue to be able to recruit and retain the best talent. And that's just frankly more easily done in the public markets. And this interview is a great example of this. This will raise our stature. And I suggest strongly that if we weren't public, we wouldn't be doing this media today. And it's an opportunity for us to be out in the marketplace to attract and retain the best talent.
And you mentioned some potential M&A activity. Any other plans now that your coffers are full, things you plan to do with the cash that you've raised?
Yeah, so part of the use of proceeds will be to reduce our debt. We've got a very strong recurring and reoccurring business model, as I mentioned. So paying down the debt is not an imperative, but we have the cash, so we'll do that here in the next few days.
Well, this has been fantastic. I appreciate your time. Congratulations on the IPO, and I wish you all the success moving forward.
It's good to meet you and look forward to catching up again soon.